Class number 12, Bonding, Understanding Risk, and Mitigating Losses. Every business must take on risks in order to accomplish their goals. In this class, we'll talk about risk and what you need to be aware of in working with your management team on the way to the future.
Credit risk is the risk of default. Liquidity risk is the risk that there may not be enough cash on hand to meet your obligations. Interest rate risk is the risk that fluctuating interest rates may cause losses. Reputation risk is the risk of negative public opinion, especially where that may cause a run on the credit union and your members pull out their deposits.
To protect the credit union against fraud, dishonesty, theft by a credit union employee, the credit union is required by regulation to hold a fidelity bond in a specific amount.
Liquidity risk is the risk the credit union has that they might not have enough cash on hand to satisfy demand. That demand usually would come in one of two forms, either a very large demand in loans or a large demand with members withdrawing from their savings or share accounts. Board members should consider credit risk in two scenarios. The first scenario would be when lending money to a member. Do they have a credit rating high enough to ensure that they will be able to have the ability to repay the loan? The second scenario would be when they were placing money on investment. Does the firm they're investing money in have the credit worthiness to return the principal and interest earned on the investment?
Directors and officers coverage provides protection to the board in case you're personally sued. It is very important for the board to understand what inclusions and exclusions your policy contains. Directors ultimately have responsibility for ensuring the credit union is meeting regulatory requirements. The directors do not have to be involved in the day-to-day details, however.
An inherent risk to credit unions is interest rate risk. The interest rate risk affects credit unions both on the share and the loan side. As part of the asset liability management process, you often shock test your portfolios to see how they would react to increases or decreases in interest rates, often as many as 300 basis points. This allows the credit union to better manage rates now and in the future.
ALM, or Asset Liability Management, is where the credit union proves whether or not they have a good handle on interest rate risk.
Reputation risk is a risk the credit union has whereby any of its actions may make the public think something less than positive thoughts when they hear the name. Oftentimes, this is a matter of not protecting member privacy or divulging other information that should not be in the public eye. Credit unions can mitigate this risk most by implementing safe and sound security practices.
The idea of managing reputation risk is to prevent the public perception, rightly or wrongly, that there is a problem with your credit union and they start pulling their deposits.
Board members are required to understand the risks found in depository institutions, including credit risk, liquidity risk, interest rate risk, and reputation risk. Credit unions are required by statute to obtain fidelity bond coverage to insure for losses caused by fraud as well as losses caused by dishonesty and theft. Some factors to consider with liquidity risk are sudden, unexpected withdrawal of member savings or extraordinary loan demand in which the credit union does not have the cash or short-term assets to fund the demand. Board members must consider credit risk when developing policies related to the acquisition of assets, such as loans and investments, and the associated policies controlling these activities. To protect board members from lawsuits brought on by members against the credit union, it is wise for the credit union to carry directors and officers coverage. Compliance risk might be more clearly defined as a risk of non-compliance. It is the risk associated when knowledge of regulations isn't solidly integrated into policies and procedures nor translated to best practices. It also occurs when regulations are not adopted across the organization. Interest rate risk is the risk to the earnings or the market value of the loans and investments due to uncertain future interest rates. Board members must consider interest rate risk during the credit union's ALM review. Reputation risk pertains to the factors affecting the organization when compliance regulations are ignored or events occur that cause the name of the organization to be blemished or its reputation defamed. Board members should consider reputation risk when dealing with member data security, embezzlement, and member lawsuits brought on by noncompliance or inaccurate processing of member transaction activity. Time to take the test. Good luck.